In 1925, a single choice redefined the global economy. A chancellor moved to restore the old value of a currency despite massive changes in productivity. This decision aimed to bring back the stability of the Victorian era. It appeared to be a return to normalcy after years of intense wartime disruption and debt. Officials believed that a strong currency represented national strength and honor. They viewed the gold standard as an essential anchor for international trade and financial trust. Before the war, the system functioned like a balanced machine. Capital flowed across borders with minimal friction, and exchange rates remained fixed for decades at a time. But the world of 1925 was not the same as 1914. Industrial capacity had shifted, and global competitors had emerged in the shadow of war. The decision-makers faced a critical trade-off between prestige and reality. They chose to ignore the underlying inflation that had eroded the actual value of their money. By pegging the currency at its old rate, they made their exports 10% more expensive. This immediate cost was accepted as a necessary price for financial leadership. Miners and factory workers felt the pressure first, as owners cut wages to compensate. The goal was to lower internal costs to match the new high currency value. Labor unions resisted the cuts, leading to massive industrial unrest across the nation. A general strike paralyzed the country as workers fought against the deflationary pressure. Unemployment began to climb as the high pound made domestic goods uncompetitive globally. The policy designed for stability was instead creating a slow and painful stagnation. Economists at the time warned that the adjustment would be too difficult for society. They argued that the economic structure could not bend as far as the policy required. But the political momentum was too strong to stop the return to gold. The central bank remained committed to the idea that pre-war parity was achievable. To maintain the high value, the bank had to keep interest rates high. This move further suppressed the domestic economy by making borrowing expensive for everyone. Foreign investors initially cheered the move as a sign of financial strength. Capital flowed into London, but it was speculative and prone to sudden flight. Behind the scenes, the actual gold reserves were becoming dangerously thin. The institution was forced to borrow from other nations just to maintain its appearance. The global economic environment began to darken as the decade progressed. Trade barriers rose around the world, making the overvalued currency even harder to sustain. Every attempt to fix the problem led to more internal pain. The government was trapped between its promise to gold and its duty to citizens. Tax revenues fell as the economy slowed down under the weight of high debt. The fiscal space for helping the poor began to disappear rapidly. Political debates became increasingly heated as the human cost became visible. The consensus that once supported the gold standard started to crumble. By 1929, the global financial system was on the edge. The crash in New York sent shockwaves that London could not easily withstand. Investors panicked and began withdrawing their gold at an alarming rate. The fixed exchange rate became a target for speculators who bet on its failure. The bank spent millions in reserves to defend the value of the pound. Every dollar spent was a desperate attempt to save a policy that was failing. Leaders met in emergency sessions, but their options were becoming non-existent. The choice was now between total collapse or a humiliating policy reversal. The social fabric was under immense strain as poverty increased in industrial regions. The logic of the gold standard felt increasingly disconnected from human needs. Finally, in 1931, the government surrendered and left the gold standard. The pound was allowed to float and immediately lost much of its value. The sudden devaluation provided immediate relief to manufacturers and exporters. Prices began to align with reality for the first time in 6 long years. However, the cost of the delay was astronomical in terms of lost growth. A generation of industrial capability had been severely damaged by the period of deflation.
The decision to return to gold had cost billions in reserves and lost wages. It served as a warning about the danger of prioritizing prestige over data. Institutions began to rethink how they measured economic health and currency value. The rigid systems of the past were replaced by more flexible monetary frameworks. The end of this policy taught lessons that are still studied by modern bankers. Future videos examine how similar decisions shaped other outcomes across different eras. Looking back, the decision seems like a clear error in financial judgment, but at the time it was supported by the most respected minds in banking. They believed the system would naturally rebalance itself without massive intervention or pain. This optimism ignored the deep scars left by the previous World War. Every country that followed this path eventually faced a similar crisis of liquidity. The gold standard became a golden fetter that restricted modern economic growth. By 1932, the global transition away from gold was almost complete. Nations discovered that internal stability was more important than external exchange rates. The lesson remains relevant for any policymaker facing a choice between tradition and reality. Systems that cannot adapt to change eventually break under the pressure. The long-term impact of this decision was a fundamental shift in economic thought. Theories of demand management arose to address the failures of the gold system. Governments began taking a more active role in directing the flow of capital. They learned that letting the market crash was more expensive than intervening. This period marked the birth of modern macroeconomic policy as we understand it today. The pain of the interwar years forced a complete redesign of the world. Yet some voices still call for a return to the perceived stability of gold. They often forget the immense social and economic costs of the 1920s. The choice made in 1925 was a billion-dollar lesson in humility. It shows how even the most reasonable decisions can lead to disaster. As we analyze these historical choices, we see the pattern of scaling consequences. Small miscalculations in currency value lead to systemic failures in the entire market. The cost was not just financial, but also measured in lost time and potential. Progress was halted for nearly a decade while the system tried to adjust. Understanding the constraints of the 1920s helps us appreciate modern flexibility. We no longer anchor our entire future to the scarcity of a metal. The decision-makers of the past acted with the best information they had available. Their failure was in assuming that the past could be perfectly recreated today. This case study remains a cornerstone of economic education for a good reason. It proves that timing and context are as important as the choice itself. Every decision carries a shadow of future consequences that we cannot always see. The Chancellor of 1925 could not have imagined the outcome. The financial world is a complex web of incentives and constraints that shift. What works in one era can be a poison in the next one. We continue to build systems that attempt to insulate us from these shocks, but the core challenge of decision-making remains the same for everyone. We must weigh the value of stability against the necessity of progress. The history of the gold standard is the history of that struggle. As we look back, we see how one decision became a billion-dollar cost. It remains one of the most significant moments in all of economic history. The final lesson is that the value of money is a social contract. When that contract breaks, the consequences are felt by every single person involved. This history reminds us to stay curious about the systems we use daily. Every choice we see has a reason behind it, even if it fails. The ghost of the gold standard still haunts many of our modern debates. Its legacy is a mixture of nostalgia for stability and fear of stagnation. We live in the world that this decision helped to build and refine. Its costs were high, but the knowledge gained was worth more than gold. The quest for a lost era of stability ended in a decade of struggle. The system now carries the memory of a choice that valued prestige over reality.